All right, before we dive in, quick disclaimer. Got to get the legal stuff out of the way.
Of course, of course.
This deep dive is just for informational purposes, okay?
Yeah.
Not investment advice, so
Right.
don't go running off making decisions based on,
Yeah. Yeah, definitely talk to a financial pro for, personalized advice.
Exactly. Always, always good to get that personalized guidance. Okay, now that we've got that out of the way,
Okay.
let's get into it. Imagine this. Retirement's on the horizon, right?
Yeah.
You're almost there. But the market, oh man, it's looking pricey. Everything seems expensive. How do you invest when you're in that situation?
It's a tough one, isn't it? I mean, especially when you're so close to retirement, wanting to make sure your nest egg is, well, safe and sound.
Exactly.
Yeah.
Yeah.
And that's exactly what we're diving into today. We're talking about how to navigate a high PE market. Price to earnings ratio, that is, especially as you're getting closer to retirement. And for this deep dive, we're going to be drawing on some insights from this report we've got. It's called Investing in a High PE Scenario.
All right, so high PE, it means investors are willing to shell out a premium, right? But the big question is it actually worth it?
That's the key question, right? I like to think of it like this. A company's PE ratio, it's kind of like the price tag you see on a house,
Okay, I could see that.
A high price tag might make total sense for, say, a big fancy mansion in like the best part of town.
Right.
But would you pay that much for a fixer-upper in a, well, not so great neighborhood? Probably not.
Definitely not.
It's the same with stocks. A high PE for a company that's got, strong growth potential, a solid track record. Yeah, it could be justified. But for a company that's, well, a bit shaky, futures uncertain, that high PE, that might be a red flag.
So how do we spot the difference? How do we know if we're looking at a mansion or a fixer-upper in the stock market?
Well, you got to go beyond just that PE ratio. You got to dig a little deeper, look at the fundamentals, especially in a market where PEs are high.
Okay, so what are we looking for specifically?
Well, for starters, you want to really scrutinize a company's earnings growth,
Are they consistently growing their earnings per share year after year? That's what you want to see. Another thing to look at is their return on equity. This basically tells you how good they are at using their investments to make a profit.
Right. So consistent growth is what we're after, not just a one-time wonder.
Exactly.
Got it. What else should we be keeping an eye on?
Debt. You absolutely have to look at how much debt a company is carrying around, and just as important, how easily they can manage it,
Right.
A company that's drowning in debt, they might have trouble meeting their financial obligations. Even if their earnings, look good on paper, it's a risk you got to consider.
Makes sense. You mentioned something earlier about reading the market's bead.
Yes.
What exactly did you mean by that?
It's all about understanding the big picture, the economic context. What are interest rates doing? Are they going up? What about inflation? Is it heating up or cooling down?
Right. These macroeconomic factors, they can have a huge impact on your investments. Like, let's say interest rates start to rise. Suddenly, bonds might look a lot more appealing compared to stocks, right? And that can cause a whole shift in investor behavior.
Okay, so you're saying we need to keep an eye on those big picture trends. What are some things we should be watching out for?
Well, things like consumer confidence indexes, See how people are feeling about the economy. Inflation reports, those are important to track. And definitely keep tabs on what the Federal Reserve is doing with its monetary policy. All these things can give you valuable clues about where the market might be headed.
So we've got the company-specific stuff to consider, and then this whole other layer of the overall market climate. It's a lot. How do we keep it all straight?
That's where diversification comes in. It's probably the most important thing you can do, especially when PE ratios are high.
Right. The classic, don't put all your eggs in one basket advice. But you were saying earlier that diversification is about more than just minimizing losses, right?
Exactly. Think of your portfolio as a ship, all right? You're sailing across the ocean, but the waters can get pretty choppy,
Yeah, for sure.
Diversifying your portfolio, it's like having different compartments in your ship. You're spreading your investments across different asset classes, stocks, bonds, real estate, maybe a little gold, even annuities, and that creates stability.
I see. So if one part of the market takes a hit, your whole portfolio doesn't sink.
Exactly. You might not see those explosive gains that you could get from, say, betting everything on one hot stock, but you're also a lot less likely to lose everything if that stock tanks. And that's crucial when you're thinking about retirement. You want that peace of mind, right?
Absolutely. Now, the report we're looking at, it suggests a certain allocation, right? It says something like 40-60% stocks, 20-40% bonds, 10-20% real estate, 5-10% gold, and 5-15% annuities. Are those hard and fast numbers?
Not at all. Think of them more like guidelines, Starting points. Your ideal allocation, it really depends on you. Your risk tolerance, how long you've got until retirement, your financial goals, all that good stuff. Like someone who's more comfortable with risk, they might lean more heavily into stocks. Someone who values stability above all else, they might prefer a bigger chunk of their portfolio in bonds.
Makes sense. You've mentioned risk tolerance a few times now. How does that factor into all of this, especially when we're talking about retirement?
It's one of the most important things to consider. As you're getting closer to retirement, you got to ask yourself, how much volatility can I handle? Am I okay with riding the market's roller coaster, or do I need a smoother ride?
Right.
Understanding your risk tolerance, it's absolutely key for making good investment decisions, especially when the market seems a bit pricey, like we're talking about now. It can really help you stay on track and not make any rash moves out of fear or even, excessive optimism.
Right. And it sounds like this is where getting advice from a financial advisor could be really valuable.
Oh, for sure. A good financial advisor, they can help you figure out your risk tolerance, analyze your whole financial picture, and then put together a personalized investment strategy that aligns with your specific needs and goals for retirement. They can also guide you on rebalancing your portfolio as market conditions change. It's like having a co-pilot on your investing journey.
Okay, so let's say we've got our portfolio set up. We've considered our risk tolerance. We're diversifying. What about staying the course? I mean, the market goes up and down, right?
Exactly. It's cyclical. The key is to take that long view. Don't get spooked by those short-term fluctuations. Remember, time is on your side when it comes to investing, especially for retirement.
Okay, that makes sense.
Even small, consistent contributions to your portfolio, they can really help you ride out those market dips and, over time, benefit from the power of compounding. It's amazing what a little patience and discipline can do.
So to wrap up, what are the big takeaways for our listeners who are approaching retirement and, trying to figure out how to invest wisely in a market where everything seems expensive?
I'd say there are 3 key things to remember. First, diversify, diversify, diversify. Spread your investments across different asset classes. It's the best way to manage risk and make your portfolio more resilient.
Okay, diversification, check. What's number 2?
Number 2 is don't just look at the P/E ratio. Dig deeper. Analyze a company's earnings growth, how much debt they have, their cash flow. Get a sense of its true value before you invest.
Got it. And number 3?
Number 3 is remember that investing is a marathon, not a sprint. Stay informed about what's happening in the market, but don't let those short-term ups and downs derail your long-term goals. Patience and consistency, they're your best allies.
Fantastic points. And just a reminder to everyone listening, this deep dive was purely for informational purposes. Okay. This is not financial advice.
Right. Always, always consult with a financial professional before you make any decisions about your investments. They can give you the best guidance for your individual situation.
And one last thought to leave you with. We've been talking about navigating a high PE market. But what if this is a sign of something bigger happening? Could it be telling us something about the future of the economy? Something to think about as you continue your investing journey?